What's up, traders? So, big thing happening today with volatility, specifically in the VXX, which is the iPath series VIX short term futures ETN. Now, why is this important? Well, a lot of people are betting that this correction is not yet over. And if the market goes down further, then volatility will increase. And VXX is a very popular product. I know a lot of people, especially in the retail space, like to trade to express this thesis that volatility will go up either by buying VXX shares or calls on the VXX. This is not necessarily the underlying product. That would be, of course, the VIX itself, which is the volatility index of the S&P 500 options. Now, why this is happening is because Barclays, which handles this ETN, has suspended issuing new shares. And so what you have is a sort of demand and supply problem where people are bidding up the VXX shares because they're not issuing new ones. And the reason for this, according to Barclays, is not because of Ukraine or any underlying market dynamics in the components, but rather because they're getting an increased margin requirement from the clearinghouse, the DTCC. So just as individual traders will sometimes get increased margin requirements for positions when the broker believes that there's going to be a problem. In other words, volatility is going to expand. Maybe the stops aren't going to be wide enough. So they're going to make you have to put up more money to hold on to that position so that they, the broker, don't take the risk. And so the clearinghouses, as I've been told, are wary of what happened last year in January 2021 with the meme stock mania, as well as Volmageddon 4 years ago. Basically, a lot of retail is betting on volatility increasing, this correction continuing, this bear market everyone says is coming. It's not. That is what people are betting on. And so a lot of people are looking at the VXX saying, look, volatility is exploding. This means the market's going down. Well, there's a big pet peeve I have about people using the VXX for technical analysis. The VXX is a leveraged ETN of an already derivative product. Now, what that means is it has this general tendency to go down because it has asymmetric risk because of the way that it's leveraged. If you want to do an analysis on volatility to try to time the market, what I do is I look at the VIX itself. And the VIX itself is actually telling us something pretty interesting. So I've been watching the VIX for the whole part of this move. And I've been noting this in my weekly strategy sessions I put on Sunday, as well as my live streams. Typically, and all through the history that I've been watching the VIX, I've even got it marked right here. The VIX tends to shoot up, come down. Let's just clean things up right here and fall off very quickly. It has a tendency to be very spiky. But something interesting has happened in the last couple of weeks. So you saw where there's a big spike up in VIX around the 3rd of December. That was the US jobs report, where it was expected that the Fed was going to raise rates because unemployment was so low. But then it fell off rather quickly. And then we had the January 24th spike up, which was, of course, a low in the market. And this also fell off very quickly. But recently, you've had the February 24th low on the market pop up. And rather than fall off quickly, volatility actually sort of created a little bit of a range, like a little wedge that's forming up here. As the lows, volatility couldn't get back down. People are betting on the correction continuing. Now, there's an interesting divergence going on, which I've noted every week now. The January the 24th low in the market, which is matched by a high in the volatility index, was at, let's call it 39. The February 24th low, which was both a new low for the S&P 500 as well as the Nasdaq, it only pegged the VIX up to about 37.77. So you actually have lows going lower. And then we had another low on March the 8th, which again on the VIX was lower. So even though the market has been making new lows, the VIX has not been making higher highs. Volatility is actually not increasing, going up as it should if the market is actually going down. And then something interesting happened in just the last couple of days, which is why I'm making this video. That is, we've come to a key inflection point. We had the high on March the 8th, and then we had a little rally that topped out on March the 14th, which was yesterday. And I was looking at this last night, and just about everything that I analyze, I look at 50% levels to tell me, okay, what's the real dividing line of this movement? And so that puts the VIX at 3318 as a resistance, which overnight I noted it on the Discord. And then here it came up and pegged it this morning. And now we have a market rally off of this VIX level, roughly speaking. This is what I'm watching. So now the key line in the sand for me on this VIX is going to be 3318. And as long as we hold this, I'm going to say that we could be seeing the end of the correction because the lows on volatility have already been going down. In other words, the fear is starting to decrease. We can see this on the VIX, which is known as the fear index. And now it's reached a key level. This was after, like I said, we had this trend of higher lows. Finally, on March the 10th, we broke below that, and now we could see a sustained return to normal volatility as the market rises. That is what I'm watching right now today. In an interesting statistic I was reading about corrections in a bull market, they tend to last an average of 71.6 days. Today is 70 days from the January the 4th high. If you've been watching my videos, you know that my line in the sand, the key level I'm watching is that February 24th low that we put in. As long as we remain above that February the 24th low that we put in at about, let's call it 410 on the SPY, I remain bullish that this is the typical correction that we get once every other year. Even though it's been a little dicey down in here, I think we're getting signs that the correction may be coming to an end. But I'll gladly come on here and admit that I'm wrong if that February 24th low is broken. But keep watching. Be looking for opportunities. There's been a lot this week in value companies, Coca-Cola, Amazon, Target. These have all been very, very good levels. And so if they become good trades and good long-term investments, well, we'll find out here in a few days and weeks. So this is not financial advice, by the way, of course, but be looking for opportunity. Trade wise, and we'll see you in the next video.